Okay, last part that we're gonna go over today are these separately stated items. So like I said, the ordinary income, that's just everything. It's our, our gross income minus all of our expenses, our ordinary and necessary business expenses. Separately stated items are those items that are they're gonna be treated differently depending upon the partner. Or they're items that aren't really part of our normal business operations, like interest, dividends, things of that nature. So these separately stated items again get allocated to each partner. So if we've got, let's say we've got our partnership has two partners, 40, 60, and we have total ordinary income of 100,000. Partner one has a salary, I'm gonna call it salary because it's shorter to write out, of 20,000, and it's already calculated into the ordinary income amount. And then we have dividends, qualified dividends of 1,000. We have long-term capital gains of 2,000. And we have section 179 of 5,000. Okay, so this is for the partnership. So we have partner one and partner two. Partner one's 40%, partner two is 60%. So ordinary income, maybe I should put it in the middle. Ordinary income, partner one is going to claim 40,000. Partner two, 60,000. Guaranteed payments. Partner two doesn't have any, but partner one has 20,000. Dividends and qualified dividends, we've got, 400, 400, 400, 400. Long-term capital gain, we've got 800 and 1,200. And then section 179, 179, sorry, is, what is this, 2,000 and 3,000. That's how that would all get separated for each of those individual partners. So if partner one, so we've got long-term capital gain of $800 here and $1,200 here. Partner one has $1,000 long-term capital loss. They're not going to be taxed on that 800, right? That loss elsewhere on their return is going to offset that gain. If partner two has $10,000 of other long-term capital gains, well, this 1,200 is going to be taxable because it's going to be added to their other capital gains. This ordinary income, they're going to pay tax on that even if they did not get any actual cash. They are going to pay tax on that. If partner one is in the, say, pays 20% tax, then what, $8,000 of tax, and partner two here is in the, I don't know, 10% tax bracket, they would pay $6,000 of tax, even though they get to claim more income, or they have to claim more income. So all of that flows through to those partners individually. That K1, so the ordinary income, this is shown. So I guess the guaranteed payments is one area where, so this would be on page 1 of the 1065. There's actually overlap here. The salary, the guaranteed payment is on the Schedule K. But those items would be on the Schedule K as well. Actually, the 179 would as well. Section 179 would as well be on the front of the return. So there is some overlap between them. So here's the K1, if you recall what it looks like. This is kind of hard to see, sorry. So you can see this comes from the Schedule K. All of these items are listed on the Schedule K individually, but this is for each individual partner. They've got their own share. You can see, so this is a 40% partner. So here, this is an example of what happens when the partnership interest changes during the year. So I owned 40% at the beginning of the year, and then in March, I bought out one of my other partners, and now I own 60%. How do I do that? Well, you have to allocate all of these items between what your ownership was for that part of the year. So for example, here we've got Knox, owned 33 1/3% from January to March, so 1/4 of the year, and then he bought out Smith, so now he owns 66.6%. Partnership had $76,000 of ordinary income, $8,000 in long-term capital gains. Now there may be some special allocations in a partner agreement that override these percentages, but we're assuming that there aren't. So ordinary income for 1/4 of the year, he'll take 33.3% of it, and then for the rest of the year, he'll get 66.6%. Same thing with the capital gain. And that's how that would be. So it does change, it can change during the year. We already talked about self-employment income, that those guaranteed payments are subject to self-employment tax. And the ordinary income is also subject to self-employment tax as long as that partner is actively engaged or materially participating in the partnership. So this is how it would be calculated. So the ordinary income would be subject to self-employment tax. The guaranteed payments would be subject to self-employment tax. The Section 179 expense would reduce self-employment tax. Because remember, if that were on the Schedule C, as a self-employed individual, you would get a deduction for it. Partnerships are eligible for the qualified business income deduction as well.